Hi guys, so we are back with another video lecture as a part of Fast Track series for RBI Grade B 2018, which has been brought to you guys by EduTap. Now we have been working in this direction for the past few years and we have been blessed with some of the very amazing results in the past few years. Now in RBI Grade B 2017 results, 124 of our students, they reached the interview stage and 27 of the students, they made it to the final list. Now apart from the different other courses which we are running, we are offering these courses for RBI Grade B 2018 examination. So these are the different courses which you guys can choose from. So there is a wide range of courses and you can choose according to your requirement. Also we are running presently discounts on the EduTap courses. So the subscribers of 2017 courses, they can get a flat 30% discount, and for this they have to drop a mail at deepak@edutap.co.in. And the new subscribers, they can get a flat 20% discount using the coupon code of 20. Now in case you need to know more, you have any query, you can always visit our website, which is www.edutap.co.in, or you can drop us a mail at deepak@edutap.co.in, or you can call us at 8146-207-241. So let us start our discussion on some of the very important questions on finance. So let us start with the first question. Which of the following correctly describes the relationship between bond prices and market interest rates? And the options are: as interest rates rise, bond prices fall; as interest rates fall, bond prices fall; stable interest rates lead to volatile bond prices; there is no relation between bond prices and market interest rates, or none of the above. So in the previous videos we have discussed the basics of the bond, and in this chapter we are going a step further. We are going to understand the relationship between the bond prices and the market interest rates. So to analyze, to understand this question and to be able to answer this question, we have to understand the basics of the bonds and relate it with the interest rates in the market. So till now we are clear about all the basic terms of the bond. We know what is the face value, what is the issue price, what is the interest or coupon rate of the bond. So now we can handle the questions like this, which can be asked in the examination. So one must know that the price of bond is not the same as the face value. For example, you may be issuing a bond at rupees 100. 100 may be the face value of the bond, but the current market price of that bond may not be rupees 100. It may be more than rupees 100 or it may be less than rupees 100, depending on different factors. Now once you buy the bonds, you can sell them to other people who are interested in buying the bonds, and when you try to sell those bonds, there may be a situation when you get a higher price, or there may be a situation when you get a lower price for your bond. So the price may be higher than face value, or the price may be lower than face value, which will depend on the market situation and different other factors, including interest rates. Now this price is determined by the demand and supply, and one major factor which is going to influence this is interest rates. So now let us understand how the interest rates and bond prices are intertwined with each other. So this is what happens. Let us understand this through an example. Suppose there is a bond which is issued at a face value of 1000 at a coupon rate of 10% with a maturity of 10 years in future. So we are given the face value is 1000 and the coupon rate or the interest which is going to be paid on this bond is 10%, and the maturity or the tenure of this bond is 10 years. Now what if the interest rates in the market rise or fall in the future? Let us take the first case. After 1 year, the interest on fixed deposits in the market decreased to 8%. Now the market interest rate has decreased to 8%. However, your bond has a fixed coupon rate of 10%. So though the market interest rate has fallen, you are going to get 10% coupon rate. So this makes your bond attractive. So many people will be interested in buying the bonds from you, and they may be ready to pay higher price than the face value, that is 1000 for that bond, and this price is going to be more than 1000. So here in this case, the bond prices have increased with decrease in market interest rate. Now there can be another case. After 1 year, interest on fixed deposit increases to 12%. Now your bond is only offering 10%, but the market interest rates have risen to 12%. Now if you wish to sell your bond, then the people will be only willing to pay less than 1000 for this bond because it is paying lower coupon rate. So in this case, what is going to happen? You are going to get a lower price than rupees 1000 on selling these bonds, and the market price of these bonds is going to be less than 1000. So in this case, the interest rates have increased in the market, but the bond prices have fallen. So here we can make out the relationship between the bond prices and interest rate. So this is the relation between the bond prices and interest rates. When the interest rates in the market fall, the bond prices rise, and if the interest rates in the market rise, the bond prices fall. So there is an inverse relationship between the interest rates in the market and the bond prices. So this is something which we have to remember. This is the crux of this particular discussion we have had. So now we can easily answer this question that there is an inverse relation between the two, and if the interest rates are going to rise, the bond prices are going to fall. So answer to this one is going to be option number A. So now let us move on to the next question. Systematic risk can be measured with the help of a coefficient which measures a stock's relative volatility. That is, it shows how much the price of a particular stock jumps up and down compared with how much the stock market as a whole jumps up and down. What is this coefficient called? Now this one is a question which has been directly picked from the RBI 2017 examination question paper. So this was a question which was asked on the risk measurement or the measurement of risk. So this question is describing a measure of systematic risk, and it is asking what is this coefficient of risk technically called. And the options are vega, gamma, alpha, delta, beta. Now to answer this question, we must be aware about the basics of measurement of risk. So risk can be defined as the possibility of loss. So this is the very simple and the most straightforward definition of risk, that it is any possibility of loss. For example, if you have bought a piece of the land, assuming that you are going to sell this one at a higher price 1 year down the line, but this carries a risk. 1 year down the line, the prices may be higher and the prices can also be lower. So this is the risk which is inherent in each and every transaction. Now what happens is, an investor and the entire market is trying to establish a trade-off between the risk and the return. The fundamental idea of the finance is to establish the relationship between the risk and the return. Now the most basic relationship between the risk and return is that if the risk is higher, the return is going to be higher, and if the risk is low, the return is going to be low. So if there is an investor who is willing to take a higher amount of risk, then there is a higher potential for return, because in this case the investor is taking higher risk and the investor needs to be compensated for taking this additional amount of risk. However, if you are investing in the securities which carry very low risk, for example you are investing in the government securities or treasury bonds, which are one of the safest or risk-free investments, and then in this case your return or the interest which you are going to get is going to be low. So the return is going to be low if you are going to invest in low risk securities. So this is the basic trade-off or the basic relationship between the risk and the return. Now when it comes to measurement or the classification of risk, we divide the risk between these two terms, that is unsystematic risk and systematic risk. Now the meaning of these terms is hidden in the words itself. Now systematic risk is that risk which is going to be affecting the entire market or the entire market segment. This is the risk which is inherent in the entire market. So this is the one which is systematically influencing the entire market. For example, the interest rates, the recession, and the global wars. These are the factors which are going to affect the market in general. So these are the general risks which are going to always influence the market. These risks cannot be reduced through diversification. This we'll understand better after understanding unsystematic risk. Now in the case of unsystematic risk, this is the risk which is associated with a particular company or a particular industry. For example, if there is a news that bank employees are going to be on a strike, then there may be a case when the investors who have invested their money in the shares of the banks, they may lose their money. However, all other securities or all other industries in the market, they may continue to remain unaffected. So this is that risk which is affecting a particular company or a particular industry. So if an investor has only invested in banking stocks, he is going to be totally exposed to this unsystematic risk, because there may be a strike or lockout in the future and this may hamper the functioning of the bank, and since he has put all his money in the banks, he will be facing this risk. Now what a rational investor should do, he should not put all his money in the banking stocks. He should diversify his portfolio. He should invest some money in the banking stocks, he should invest some money in the automobile stocks, and some in FMCG or other markets. So this unsystematic risk, it can be reduced if the investor diversifies his or her portfolio. But this is not the case with the systematic risk, because this is the risk which is going to be there irrespective of the company you put your money in, irrespective of the company you purchase shares. So this risk cannot be reduced through diversification. Now when it comes to measurement of risk, a very important measure is beta. Now this is the measure of the volatility or the risk of a security of a portfolio in comparison to the market as a whole. So what happens? The systematic risk, as we have studied, is going to influence the entire market, but some stocks may have more volatility with regard to these risk factors as compared to the market as a whole. So with this beta, we are trying to measure this volatility. So if you find out the beta of a stock, for example, a beta of a stock comes out to 1.2, it means the stock is 20% more volatile than the market. So the factors which are influencing the market in general, the systematic risk factors, they are influencing that particular stock 20% more. So that stock is 20% more volatile. So if the market returns are going to be adjusting a little bit, say by 10%, that particular stock's return are going to be affected in a 20% more amount, say around 12%. Conversely, if an stock's beta or the portfolio's beta is 0.65, it means that stock has 35% less volatility than the market portfolio, than the market as a whole. So this means that particular stock's returns are going to be less affected with the change in the returns in the market. So if you are interested in the stocks which are less volatile, you should go for the stocks which have lower beta. So if the beta of a stock is 1, this indicates that the securities price is moving along with the market. As the market changes, the price of that security changes in the same direction and by the same amount. A beta of less than 1 means that the security is less volatile than the market. So this means that the security is less fluctuate, the return on the securities fluctuate lower than the market fluctuations in returns. And if the beta is greater than 1, this means the securities price is more volatile than the market. So this is about beta, which is a measure of risk. This is very important, and a question can again be asked on any aspect related to this beta coefficient. So now we can easily answer this question, that the systematic risk is measured through a coefficient, and that coefficient talks about the movement in the price of that particular stock with the movement in the stock markets. So this coefficient is very important and is called beta. So answer to this one is going to be option number E. Now let us move to the next question. Emerge is a platform of which of the following stock exchanges in India intended for small and medium sized companies? So this question is based on the basic information regarding the stock markets, and this one is asking about Emerge platform, and this is asking to which exchange this platform belongs. Options are Bombay Stock Exchange, National Stock Exchange, Over the Counter Exchange of India, Calcutta Stock Exchange, or Delhi Stock Exchange. So to answer this question, we must be having some basic understanding about the Indian stock market, and we should be following the current affairs relating to the same regularly through newspapers. Now, Indian stock market is one of the oldest and the most robust markets in Asia, and most of the trading in the Indian stock markets takes place on two very important stock exchanges, and these are Bombay Stock Exchange and the National Stock Exchange. This Bombay Stock Exchange, or BSE, it is very old and it is in existence since 19th century. And the National Stock Exchange is a recent one. It was founded in 1992 and it started trading in 1994. Different procedures regarding trading mechanisms, trading hours, settlement, etc. They are same on both the stock exchanges. Now, another important fact which you guys must be knowing, but still to cover the same, the Bombay Stock Exchange Index is known as Sensex and the National Stock Exchange Index is known as Nifty. So this is the NSE Emerge, the SME growth platform, which is often seen in the news. So the SME growth platform of the National Stock Exchange is known as Emerge, and it is intended for small and medium sized companies with high growth potential. So there may be a situation in which the company is small and medium one and they cannot afford to go into listing in the BSE and NSE because they have complicated requirements and a huge amount of money is required to be part of those indices or exchanges. However, these exchanges has come up with a separate SME platform, and this platform for NSE is Emerge platform, and this platform allows new early stage ventures and small quality companies so that they can raise much needed capital as they need to grow, mature, and then at a later stage, when they have matured and when they have grown, they can transit or migrate to the exchange main board, so they can later exchange to NSE from NSE Emerge. So now we can easily answer this question that Emerge is a platform of National Stock Exchange and is intended for small and medium sized companies. So answer to this one is going to be option number B. Now let us move to the next question. Suppose there is a project which requires initial outlay of 20,000 and it yields cash inflow of 8,000, 7,000, 4,000 and 3,000 in years 1 to 4. What is the project's payback period? So this is a question which is based on the capital budgeting topic of our syllabus, and a very important technique with respect to capital budgeting is payback period. So this question has given us some data, some factual information, and it is asking us to compute the payback period. And the options are 2 years 9 months, 3 years, 3 years 8 months, 4 years, or none of the above. So to answer this question, we must be aware about this technique of capital budgeting, which is payback period. So this is the technique which is one of the very popular techniques in capital budgeting decisions. This technique tells us the number of years which are required to recover the original amount which has been invested in the project. For example, You have invested rupees 100 in the project, and that project is giving you an annual return of rupees 10. So this means it is going to take 10 years to recover your initial investment on the project. So the payback period is going to be 10 years. So mathematically the formula becomes the payback is equal to initial investment, that is 100, divided by annual cash inflow, that is 10. This means 100 by 10, or 10 years, that is going to be the payback period. Now if we have to make decisions based on the payback period and we try to evaluate 2 or more investment situations using this particular technique, then we can find the appropriate project using this particular thing, that is, lesser the payback period, the better it would be. So it would mean that your investment is being recovered at an earlier stage, so it means that this is better. So lesser payback period, better it is. Now let us understand this through an example. Suppose the project requires initial outlay of 50,000 and it yields cash inflow of 12,500 for 7 years. Then the payback period for the project would be how much? So this is very simple. We simply have to divide initial investment and the annual cash inflow. Initial investment is 50,000 and the annual cash inflow is 12,500. So the payback period is going to be 50,000 divided by 12,500, that is 4 years. So 4 years is going to be the payback period in this particular case. Now let us move towards the problem which has been given in the question. Now in this question, the most distinguishing factor is that the cash flows are not equal over the life of the project. Here the cash inflows are unequal. So you cannot straightforward apply that formula to find the payback period. You would have to use a bit of hit and trial and bit more of your mind to solve this one. Now for solving this one in an easy manner and a very organized manner, it is advisable to prepare this table. So in this table what we do, we put the cash inflows over the years on one side and we compute the cumulative cash inflows along with this figure of cash inflows. So this means in the first year the cash flow is 8,000, the cumulative cash inflow till now is again 8,000. In the second year the cash inflow is 7,000, but the cumulative cash inflow of second year, it means the cash inflow of year 1 plus the cash inflow of year 2. This means the cumulative amount is now 15,000. And in the year 3 the cash inflow becomes 4,000 and the cumulative cash inflow is going to become 19,000. So we have to recover 20,000 and we have recovered 19,000 by the end of year 3. So this is very obvious that the payback period is going to be beyond year 3. In the fourth year the cash inflow is 3,000, so the cumulative cash inflow is going to be 22,000. So in the fourth year we have exceeded 20,000. So the payback period is going to lie somewhere between year 3 and year 4. So in the first 3 years our cash inflow is 19,000 and the remaining inflow which we require to meet the initial investment is 1,000. So in this case we have to recover only 1,000 in the fourth year and we are recovering total amount of 3,000. So 1,000 is going to be recovered in 1,000 divided by 3,000, that is 1/3 of the year, or 4 months. So this amount is going to be recovered in 4 months. This is very simple if you understand this one logically, that if you are recovering 3,000 in 12 months, you are going to recover 1,000 in 4 months. This is very simple. You can solve this one just using the unitary method. So your payback period is going to be 3 years and 4 months. So this is very simple. So now you can solve this question, that the payback period for this project is going to be 3 years 4 months, and the answer is going to be option number C. Now let us move towards the next question. Which of the following capital structure theories can be classified as relevance theories? So this question is based on the classification of capital structure theories, and it is asking which of the following theories are relevance theories. The points which are given are net income approach, traditional approach, net operating income approach. So these are the theories which are given, and the options are 1 and 2 only, 2 and 3 only, 1 and 3 only, 1, 2 and 3, or 3 only. Now to answer this question, we must be aware about the capital structure theories, and first we should be aware about the meaning of the term capital structure. Now to understand the meaning of this term capital structure is very essential, because it is going to be used many times in the topics of finance. Now the capital structure is simply the combination of capitals which you have raised from different sources of finance. For example, you may have raised some money from shares, which is your owned funds, and you may have raised some money by issuing of bonds, which is your borrowed funds or debt. Now, the capital structure decision involves deciding the forms of financing. For example, whether you have to use shares or you have to use bonds or debentures to obtain money. So the forms of financing are an important part of capital structure decision, and then it comes actual requirement of different forms of financing or amount to be funded. So you have decided that you have to raise money through issue of bonds, but then you have to decide how much money you have to raise through issue of bonds. Whether entire money is to be raised through issue of bonds and some money may be raised through issue of shares, or any other case. Next is a relative proportion of different forms of financing or mix in total capitalization. So we have decided that we have to raise money in the form of debt as well as the shares. Then we have to decide how much is going to be the proportion of debt and how much is going to be the proportion of shares in the total money raised. So these are the questions which arise when we make capital structure decision. Now there are different capital structure theories, and these theories provide us a useful guide in making the capital structure decisions. So this is the crux of capital structure. The firm has some assets, and these assets are to be funded using debt and the equity, which are the different sources of capital, and the composition of the total capital in terms of the amount of debt and the amount of equity is going to be your capital structure. Now when we talk of classifying this capital structure theories, this is done based on this question. Now if you are able to answer this question, you can easily understand the classification of capital structure theories. Now the question is whether the composition of capital structure influences the cost of capital and the value of the firm, which is the value of debt as well as the equity. So it is asking whether you should be worried about the composition of your capital structure, how much debt and how much equity you have to raise, whether this is going to affect your cost of capital and the value of the entire firm. Now the different theories are there. Some say that yes, this is important, and some say no, this is irrelevant. Now on the basis of this question, we have divided the capital structure theories into relevance theories and irrelevance theories. So relevance theories are the one which feel that the composition of capital structure is relevant in determining the value of the firm and the cost of capital. So it says that how much amount of debt and how much amount of equity is there in the capital structure. This is going to be influencing the value of the firm and the cost of capital. However, on the other hand, there are irrelevance theories. Irrelevance theories, they imply that the composition of capital structure is going to have no effect on the value of the firm. So you may raise entire amount from equity, you may try to raise maximum amount from debt. This decision is not going to affect the value of the firm and the cost of capital. So this is the irrelevance theories. So this is the broad classification. The capital structure theories are divided into relevance and irrelevance. Under the relevance theory, we have net income approach and the traditional approach. So these are the approaches which feel that the composition of capital structure is relevant to the value of the firm and the cost of capital. On the other hand, the irrelevance theories, they are net operating income approach and Modigliani-Miller approach, or MM approach as it is popularly referred to. So these approaches feel that the composition of capital structure has no effect on the value of the firm. So this is something we have to remember, that there are relevance theories and irrelevance theories, and these are the relevance theories and these are the irrelevance theories. So now we can easily answer this question, that relevance theories in this case, they include net income approach and traditional approach. Net operating income and approach, they are irrelevance theories. So in this case, the answer is going to be option number A, 1 and 2 only. So guys, this is all about today's discussion on some of the very important aspects of the finance chapter for the upcoming RBI Grade B examination. Thank you guys. If you found this video useful, please like the same and share it with your friends. And for more similar videos, please subscribe to our channel on YouTube. Thank you.